For those that don't know me, my name is Omri Ben David, and I'm a partner at Viola Ventures, the early stage investment part of the Viola Group. Next on the agenda is a much waited for, at least on my end, conversations with the panelists that I don't think need much introduction. They have built and run global fintech unicorns, and it's a pleasure to have them join us. So we have Assaf Vand, is the co-founder and CEO of Hippo Insurance. Eyal Shinar, co-founder and CEO of Fundbox, who was recently appointed as chairman as well. And Scott Galit, who is the CEO of Payoneer. Thank you guys for joining. We have lots to talk about. Obviously an interesting time for the fintech industries and your company in particular. So let's jump right into it. So I think one of the things we saw on the Startup Nation Central report was, while funding is growing and is very sizable in Israel and definitely globally, we see a decline in fintech funding in the early stage. Wanted to get your opinion. What are the implications for the sector, and what do you guys see opportunities in fintech that you would encourage entrepreneurs to pursue? Maybe we start with you, Assaf.
I had to unmute, sorry for that. I think there's a lot of demand. I'm just trying to kind of summarize the report that we've seen. There is a shift to, I would call it more of a safety to the bigger rounds rather than the smaller rounds. But when I was looking to, when I'm prepping for this panel, one of the things that I was thinking about is that if you look at the companies that are doing well and are raising the big rounds, it's they're focused on as big as a market as they can and actually touching the customer at the end of the line, as opposed to being an enterprise software company that is focused on the financial institutions, which is still bucketed under fintech. But most of the companies that you see that actually raise a lot of money are the ones that have differentiating the product as well as the customer experience. And this would be something I would really, really focus on if I would have started something in fintech today.
Thank you. Great. Eyal, anything you'd want to add to these observations?
I think Assaf touched most of it. I would add, generally speaking, you see more, regardless of fintech or not, you see more and more investments trying to chase the late stage opportunities. It's a trend that started a while ago, and you see it now becoming more evident, especially when with a lot of risk and uncertainty going forward for obvious reasons, more than usual. In the later stage companies, especially those that are doing okay, plus during COVID, they get a premium from the more institutional investors. So you see that trend only becoming stronger. Being more of a contrarian, I would say if I were on the investment side, I wouldn't rule out early stage investments in fintech. Obviously, mortality rate would be higher there by definition. But I think there's a lot to innovate. And fintech now is a very big word. It's almost like saying tech company, right? It's covering almost every aspect of tech. So I would not discount the opportunities in the early stage.
Great, encouraging. Scott, anything to add?
Yeah, I mean, maybe I'll pick up on a theme that Eyal just started and kind of bookend things a little bit. I agree with Eyal. I mean, technology is transforming really how all businesses and all consumers all over the world are interacting with every aspect of their lives, and financial services is no different. So I expect that technology innovators will continue to be able to deliver customer-centric, highly usable, rapidly deployed and rapidly iterated solutions much faster than most incumbents in financial services will be able to. And so as a result, I really do think that the opportunities in and around fintech continue to be really exciting. On the opposite side, I would say there has been a massive investment in fintech, not just in Israel, but globally. over the last several years. And in practice, there's a lot more companies that have gotten investments than actually have real strong sustainable business models that have good unit economics. And I think we will see increasing focus and increasing discipline from investors in really trying to understand which businesses are chasing other businesses and which businesses are really chasing real markets that have real compelling value propositions and also economics to the business models.
Yeah, and I share the sort of the positive sentiment around fintech and early stage, obviously out of position as well. But COVID is all around us. S&C mentioned it in their report. You guys mentioned it in your answers, at least some of you. So let's switch gears and talk a little bit about the implications. What adjustments have you guys made, and I would say in a kind of the short, medium term, to your businesses, and in the potentially longer term? And I'm talking about strategic, financial, operational. If you can talk to us a little bit about those different time horizons. So maybe Eyal, I'll start with you on this one.
Yeah. So on the on the personal level, I don't enjoy COVID too much. I'm kind of getting I need a change of scenery, and that's an easy problem to have. I think if you actually know people that are sick, it's becoming much more personal and emotional. Mm-hmm. From a business perspective, it's an interesting time for me, at least, since we started the company, just because there are really big shifts. Very quickly. It's like the time is being compressed into a few weeks. And 1 week you could, be in a mode of, we need to save the business. We're all going to die. And 2 weeks later, like, whoa, like, how are we going to be the number one player in this market? So I would divide it to, very roughly speaking, adjustment to the different timeline and speed of things that's going on. Moving quickly from, a traditional office type of company, we have 3 offices, to everything online. And I think companies that have few offices are in advantage. We were lucky. I think even today, which is not the height of, the peak of COVID, hopefully, at least not the initial panic, we are still functioning in better efficiencies than we were before COVID. Which is an interesting data point, but stuff that was, originally we predicted going to take a few months, it's taking a few weeks. So how do you run the organization in a more efficient way? And that's something that you need to plan ahead. It's not going to be over by the end of the year. So are we going to move to completely remote or semi-remote type of work distribution? And then more the strategic thing that we're going to do. Initially it was more of a defense, especially for companies in fintech that have exposure, whether it's balance sheet exposure or payment exposure, and how do you move from the defense to an offense? And that's exactly where we are now. It's a different, landscape, meaning we see much less competition and much more demand for the product. So how do you do it in a way that capture this rare opportunity in time? On the other hand, how do you make sure that you do it in the right timing? Because if it's a second wave, and there's also election in the US, how the economy is going to shape up at the end of this year. Very interesting strategically speaking, and what are the big decisions and bets that you're taking. Because you can make a lot of mistakes now. And it feels to me that mistakes during COVID could be much more meaningful to your business than during peacetime. So we divided to how the organization is working, what are the strategic bets, and how do you go all in on them.
And maybe Eyal, as a follow-up question before I turn to Scott with a similar question, what can you talk, maybe double click on your specific space, SMB lending, what type of impact have you seen? How do we think about underwriting frameworks, balance sheet, if you can, touch on that a little bit.
Sure. So as I think most of you, all of you know, small businesses really were the first line of COVID. Even before the lockdown, at least in the US, people just stopped going to restaurants. You stopped going to a coffee shop. And I would divide the small business ecosystem to B2C businesses and B2B businesses. B2C obviously being those businesses that, you know, service us consumer directly. So restaurants, you know, hair salons, spas, coffee shops, they very quickly suffered pretty much annihilation. Like you see a bunch of restaurants just out of businesses. And this is even in the Bay Area where, you know, people are willing to pay pretty high margin for, you know, the services and products they get. The B2B businesses are businesses that selling to other businesses. So think about another small business that's selling to that restaurant, or another small business that's selling to Target or Walmart. And luckily, and a little bit by design, but not because of COVID, Fundbox focused mostly on B2B businesses. And we didn't get as hit as bad as we could have if we were focusing on B2C businesses. So you see in the market maybe 20 different traditional and more of a FinTech 2.0 lenders that have more exposure to B2C businesses. And they are pretty much either completely out of the game, or they're in the game, but they're going back 3 or 4 years because their lender, their warehouse provider, pulled away the line. Those are usually the businesses that have more exposure to B2C businesses. And for Fundbox specifically, what it creates is, you know, opportunity. Now, I wouldn't go and try to acquire more B2C customers at this point, just because I don't think COVID is over. And also part of our strategy is to focus where, you know, we call it the dark side of the economy or the dark side of the moon. You have much more, 67% of US businesses are B2B businesses, but because they are less visible, they get less, you know, innovation, less investment. So for us, it's a strategy, but overall the landscape of small businesses got hit very bad. And I think that's part of the reason why you see less funding to new startups in the space. And the companies that now survive, also some of these another layer of compliance and regulation, which strengthening the moats around the businesses at a little bit later stage. So it creates a lot of opportunities, but it also makes it much harder for earlier stage startups in the space to grow.
Yeah, appreciate it. Scott, over to you. Can you talk about the adjustments you guys have made at Payoneer, you know, short, medium term, and sort of things that are longer term?
Yeah, sure. I mean, for us, it's been interesting. I mean, we started to deal with COVID in January with our teams in China and Hong Kong and our customers there. And so a tremendous amount of challenge and uncertainty that we quickly had to start dealing with, and really trying to focus on making sure our employees were okay and our customers are okay. And obviously for all of us, or most of us, that's obviously kind of carried across the rest of the world. Pretty quickly after that, we started to focus, and this is early February, on our working capital business, where we suddenly recognized, you know what, machine learning models sound amazing, but in a time of such great crisis and uncertainty and dislocation, actually you can't really count on the machine learning models to actually really appropriately incorporate all the relevant data points and make the right decisions. So we actually needed to make some pretty quick changes to our working capital platform and adjust our approach there. And fortunately, we acted early. We recognized just how correlated activity all over the world was. I mean, we had customers in Western Europe, US, and at that point, this is before COVID was really a problem in the West at all, but we recognized that we really couldn't easily figure out who had supply chain exposure to China and what that might mean. And so all of a sudden, we again kind of better understanding and appreciating just how interconnected the global economy was, and just how quickly some of these issues would create challenges in different geographies around the world. Echoing something Eyal touched on from an employee perspective, we were, more lucky than good in that we've been building out our global platform and our global employee base and our global years. So we already had an infrastructure covering several different continents with kind of digital communications and collaboration infrastructure in place. We already had tools for how we actually regularly communicated with customers through digital channels, and we just needed to amplify all of that. So figuring out in more how to take advantage of those tools and go from simply feeling kind of fortunate that we had them in place to thinking about, all right, how do we remake, in New York, for example, we have this Friday lunch that we get everybody sitting together, eating together every Friday and have all kinds of discussion level of employee engagement. We still do our Friday lunch. We actually now invited our California teams to join for breakfast. Have our Latin America teams join. So all of a sudden, the way we're engaging our employees, we actually leaned in and extended it. Very much started to embrace not just having a global team and a global platform, but actually figuring out how do we now allow more flexibility, bring in more people in more places, closer to more customers, and leveraging technology to help us do that, onboarding the employees, and actually allowing them to operate fully remotely. And then as it relates to customers, recognizing that, again, we've been pretty fortunate that our business in general, we have focused on digital businesses. So businesses that in some way, shape, or form are digital. And as a result, we've really seen for most of the categories we focus on, a pretty significant increase in activity and also the pace, but also the complexity and uncertainty. And so we've really actually focused our efforts on reinforcing our scale, our strength, our stability, the flexibility and durability of what we do. And we've really tried to much more consistently and frequently embrace our customers and communicate with them. So again, when you can't meet with them face to face, increase the frequency and actually try to touch them more often through digital channels. So overall, I mean, it's been, if it wasn't so painful for so many people in so many places, it's been, kind of intellectually really fascinating and a challenging problem to try to work through with about as many opportunities as challenges.
Perfect. Appreciate it. Assaf, over to you, maybe from the insurance side, and then we'll have to talk about Lemonade IPO as a follow-up question. So I'm preparing you for that. But let's start with kind of your observations on the adjustments you guys have made.
Sure. I think the adjustment, I don't have too much to add. What Eyal and Scott have said, working remotely and all of that kind of stuff. What I want to touch on the adjustment that I'm seeing from a corporate kind of standpoint. The first one is, I think a lot of people actually that are used to work remotely, seeing that productivity hardly being impacted. There's less travel, people are getting settled. So that's not an issue. Where I do see that something is hurt is the creativity. There's no corridor discussions. There's no intermingling. People are starting to work a lot more vertically in their silo. So the engineers are working with their engineers and delivering, but there's a lot less discussion with the insurance people, with the marketing people. And I'm trying to have these like coffee chats and people talking amongst themselves. This is where I'm seeing some of the damage that happens from the COVID that I don't really like. Insurance-wise, it's actually really interesting. There's this word insurance, but it's such a diverse world. So health insurance is one side, life insurance and P&C, each one, other than having the word insurance at the back of it, are very, very different business. And even within them, there's very, very different changes. So life insurance, you would think they're going to be hurt significantly by COVID, but there's actually been less mortality because people are, at the beginning, the first 2 to 3 months, driving cars, there were a lot of less things that happened. But on the flip side, interest rate went down, and that crushed the life insurance industry a lot more than COVID. Health insurance, there weren't a lot of elected, basically, procedures. Hence, the cost went down. But on the flip side, in the US system, maybe the health insurers are still making some money, but the hospitals and all of that kind of stuff some of them are close to bankruptcy. On the PNC side, which is where I'm focused on, I would break it into the two kind of big buckets, which is commercial PNC and basically direct or the simpler lines. And what you're seeing is that on the commercial, there has been a lot of blood on the street. There's those bankruptcies. There's questions on should the insurance companies even pay for the pandemic, which I have a very clear no on that. But it's a political topic. But on the personal lines, when you see it, auto insurance had the best time of their life in the first 2 to 3 months. Nobody was driving the cars. Loss ratio that you file is 70 to 75%, and if you don't have any claims, then they were making money. Hence why they started to give money back to customers and things of that sort. On the home side, it's as close to a beta of 0 as you can find. So I'm not saying there hasn't been changes, but overall they were almost insignificant. People were staying at home. As long as you have a home and you pay a mortgage, then you're going to need to have your insurance. So there hasn't been too much, if at all, there hasn't been higher rate of delinquencies and stuff like that. A couple of things that did change were, one, what you did see is that frequency on some components of the claims has changed because equipment breakdown and things of that sort increased, but breaking and entry decreased. People are staying at home. So the shift of claims have changed. And our homes were not used to have people cooking 3 times a day for 5 people, having 15 showers and all of that. They just were not set up. So you see a lot of breakdowns of a lot of small components. But on the flip side, the frequency has, the severity has declined, because if there's a small leak, you capture it on the point and you're not coming home after 8 hours at work and then you see that there was a full flood in the house. Severity has went down overall, but it's not that impactful. For us specifically, I would say there was a bit of a shift in channels. So direct to consumer increased, but the customer base has changed. A lot less new customers that are new home purchases and more switchers, because one of the first things that happened, people looked at how can they save money, and they stood in front of their computer and they want to make sure that they have enough money. And now there's an easy availability to actually get a quote and bind really, really easily. And we also help them basically cancel their policy, announce, let the mortgage provider know. What you did see is that some of these, there was a shift. So some companies that we work with that are basically mortgage originators, because the interest rate was so low, there was a lot of refi, and we were doing very well on that side. But some of the other channels, companies like homes, has been a decline. But March and June were actually very strong home buying months in the US. Everybody stayed enough time in their home. And then when they became more settled, then you see, oh, what I really need is another home office. What I really need is a backyard. And there was a pent-up demand of a lot of people that are actually doing either projects to kind of fix their home or buy a home. So overall, it's close to a beta 0. This is what we're seeing. Hasn't been impacted. Hence, as a company, we haven't let go of anybody. We haven't reduced salaries. We just recalibrated the projects that what we're working on. One last point. I do think that for FinTech, it sped up the world by 2 to 3 years to the move to basically online distribution. I think people that were not used or didn't want to take a loan or didn't want to take insurance are feeling a lot more comfortable doing now digitally.
Great. So I mentioned it earlier. Let's talk about Lemonade for a second. Obviously, a big story in Israel, a big story for the audience, a big success story, if I may add, a big comp for you, Assaf. Priced its IPO on Wednesday, Thursday traded 140% up. Last I checked today, about 30% up. Can you give us your views on the IPO story, the trading characteristics? How do you sort of see this phenomena?
Yeah, I'll try less about the company, because I do find quite a lot of interesting things with that. firstly, massive kudos, and I think it's really, really good for the entire industry, fintech and insurtech as a whole. You know, it's a different thing, and I think it helps Lemonade build a proper franchise, and kudos for them on that. What I do see, I just want to point several interesting things. First, I think it's an horrific outcome by the bankers. They basically left, according to today's stock price, I don't know, $500 million on the table. That's not a very good outcome. And that's a really, really big problem that they should ask themselves. But a lot of the questions is why, and what you're seeing in the market, because we can have a 5-hour discussion about the separation of Wall Street and Main Street, which is happening now in the world. How companies like, I know, Tesla is worth more than the rest of the car companies, and how Impossible Food is worth more than Heinz and General Mills together. There's a lot of disparity in this thing, which I think is really interesting. There is a rise of retail investors, the Robinhood investors, which is really, really interesting as well. There's no gambling, or a lot less gambling. There's no sports, and people are shifting to the online market, and they're trying to go to brands that they acknowledge and stuff like that. That this is something that Lemonade did a phenomenal, like a really, really good job on branding, on storytelling, on creating a loved brand in insurance. And this is something that I think is really, really interesting. They built a millennial brand, which I think resonates and has a very high correlations to the retail investors that are investing now. So this is something that I find also interesting. I think one of the interesting questions that I'm asking myself when I'm looking at the Lemonade story is the following question. The question that I'm asking is it better for Hippo to be covered by the insurance analyst of Wall Street, or by the consumer internet guys in Wall Street? Lemonade clearly took a path of retail, basically, consumer internet. Their benchmark that they presented to the market were Netflix and Wix and things of that sort, and not the insurance side of the business. Clearly it works, so there's no question, although it's on the retail side and less on the institutional side probably right now. What the interesting thing, and this is the kind of the weary point that I had, when I was examining the market in depth, and I looked at several brands that went the route of consumer internet, when the market realized that there is a risk component, which insurance basically has, and not a negligible one, a lot of the investors dumped them. So companies like OnDeck and Lending Club and Green Sky, a lot of them are very valid, good companies, but went a route of consumer internet. Once the story wasn't clear enough, because people didn't understand the change in the adversibility that has to do with the risk, the stock tanked. It's an interesting intellectual debate, and at different point you get different signals from the market. Clearly, Lemonade took the good route. It's a crazy and amazing valuation for them. It's a good benchmark for me, which I'll take any day of the week. It's still something that needs to be seen and monitored closely.
Yeah. We have a lot of entrepreneurs in the audience. Do you think a successful IPO like this, and we can debate the banker's role, et cetera, as you said, do you think it drives more entrepreneurs to go public in Israel or abroad?
Two things. One, going public, it's a path. It's not the goal. It's another way to get more funding. It has pros and cons. You need to deliver quarterly reports. You need to under promise and over deliver over a certain period of time. There's a lot of cost that has to do with that. You need an IR team and stuff. It's like $2 to $3 million extra cost a year. So you need to really wait whether the company is in that kind of phase that you can actually say exactly what's going to be your revenue in the next quarters, the next several quarters, and deliver on that. So it's not the end goal. I think for a lot of companies, and especially investors, going public is one of the, it's like the holy grail. If people can do it and it's a valid option, they would probably do it. I don't think that having a successful IPO is something that is, would weigh or change. I think companies need to check whether they think they can go public. I think this is a good signal that you can probably go public way earlier than what you thought for, what was the benchmark that you set for yourself before. You know, with Eyal and Scott, you can probably ask them. I am 100% certain that by looking at these comparables, both of them can be a really nice sized public company now. So they should just check themselves, you know, whether the timing is off. I do think, by the way, that for a long time, because of availability of capital, which is still out there now, some companies stayed private for too long. Airbnb should have been a public company 2 years ago. Uber should have gone public before. There's been a shift on who's capturing value, whether the public investors or the private investors and stuff like that. It's very enticing to stay private as long as possible. You can do a lot more experiments. You don't need to deliver as much. It's a very interesting shift. And I do think it raises a question on the right timing to go public.
Yeah. Perfect. So Michal is from SNC is running a poll. We can see what others are thinking. We have about 5 minutes left. Eyal, maybe I'll turn over to you. Be happy to kind of quickly, if you can opine on, does it drive more entrepreneurs to go public? Yes or no, kind of your viewpoint. But I think, you know, each one of you kind of is built a unicorn or a successful category leader. If you can, you know, talk a little bit about an advice you'd give entrepreneurs who aspire to build such category leaders, what to do, what not to do, what you would have done differently if you started over. Would appreciate your thoughts.
Yeah, so at first I agree with everything that Assaf said. I mean, lemonade is a hot topic, so let's talk about them a little bit. Generally speaking, if you're close to what's happening now in the public market versus real economy, it's mind-blowing to me. It feels a little bit like, I don't know if you guys follow history, but what happened in, you know, Austria and Germany back in the 20s, where you had this, for other reasons, like big money printing efforts to pay debt. It's a little bit different with the US. And people in the real economy were in pretty bad shape, but the public markets were breaking, breaking new prices every day. And what we see here is maybe, I don't know, nobody knows what's going on, but you see an inflation in the public market prices versus the CPI indices. So everything that suggests a real growth and not just multiple growth, which is namely technology, is starting to break records. And there's so much demand, whether it's from the Robinhood crowd or institutional money, to put your money in something that can actually create returns, that every new IPO, whether it's a no-brainer IPO or just an okay IPO, you see a lot of money pouring into that. So I actually got a lot of inbound from investors. Hey, maybe we should go public earlier. It's a unique, time. If it stays until after the election, which is a big if, it makes a lot of sense. So it's becoming a topic for entrepreneurs for sure. I know that companies that probably not ready to go public are about to go public, and it may work. I mean, it worked in 98 and 99. And there was a certain window of opportunity to get, liquidity for the company, liquidity for employees and investors. I don't know if it's exactly the same thing because the real economy is not having a great time, at least not yet. When it goes to, founder that's starting a company that hopefully would be a category leader, I think nothing changed. Like you're building a good company. Eventually it's gonna, a little bit of luck, a lot of talent, and mostly hard work. That's what you need in COVID days or non-COVID days. Like I wouldn't even think about IPO at this point. I agree with Assaf. Like I keep preaching it internally. The IPO is not a goal by itself, but it is a goal to be a self-sustainable business. So you don't have this dependence in capital markets. And once you're a self-sustainable business, you can go public or not. It's up to you, but in a point of strength. And you want to build a company that can get to that point in scale, obviously. I do think if you look at the best performing, let's call it companies, exits, whether through IPO or M&A, those that were built in time of crisis, namely 2009, were actually a very good vintage of startups. So my gut would be that in the next 12 months, starting a company, not for the sake of starting a company, but starting a company, whether it's fintech or something else, that would be a very good time. It does depend a little bit of how the world is going to shake up. Like, what do you want to focus on? What do you want to solve? But there's a whole new set of problems and solutions now, culturally and technology speaking. If someone is debating, I wouldn't take the IPO as a reason to start a company or not. But that always goes and come back. It's more about, do you see a problem or opportunity now that is just too powerful for you to say no to? And I think it's a good timing.
Yeah. And Scott, over to you. I don't know if you want to talk about IPOs as well, or maybe just talk about a little bit about the journey, within Payoneer. How has that sort of shifted from when the company was founded to today? What sort of the path ahead, if you can sort of talk to entrepreneurs in the audience in terms of what has changed and what sort of, kind of changes the new normal in these circumstances. So maybe you'd love your parting thoughts on that.
Yeah, a couple things. I mean, one, I really appreciate a lot of what Assaf and Eyal were talking about. I mean, a little over 20 years ago, I was an investment banker taking internet companies public in the late 90s, did the eBay IPO, Priceline IPO, and it is truly remarkable, as Assaf was going through, his list of considerations and challenges, they're almost to a one the same things that were coming up in the late 90s. What research analyst does eToys go to, right? I mean, it's so many of these things are issues that we've been talking about for so long, pricing issues, research analyst issues, and also in many cases, the confusion between, the IPO as event and the public company as ongoing, responsibility, burden, challenge, also opportunity, and really the importance that I think both Assaf and Eyal emphasized of, the IPO is a step on a journey for a company and for the CEO and for the employees to help them execute on their vision, achieve their goals, and it's one of the ways. It's not a goal or an end unto itself. And I would say one of the other things that kind of comes up, and I think it is important for entrepreneurs to have this in mind, for many years as entrepreneurs, we heard things like, your responsibility is to create shareholder value, your obligation is to the investors. And then you start to hear about kind of different constituencies. And I think, part of where there can be misalignment of incentives and there can be confusion in a role as CEO, I'm a very big believer that value to shareholders is an output, not an input. Meaning, I really strongly recommend focused on customers, focus on employees. And if you have an idea of where the world is going, an idea of where you're trying to be and the role you're going to play in that future view of what the world looks like, you focus on customers and what they need in order to get to that point, and you focus on employees to help them get there, that you will, as an output, create value for shareholders. And as you see companies going public and shareholders get excited about the opportunity to hit the market and create pressure on entrepreneurs to make decisions based on, either short-term trends or financial outcomes, you can start to lose, I think, some of those very basic and most important decision-making criteria. And I think that is where you can run into risks and issues. So again, IPO can be an amazing step on a journey, can build brand, can create, more sustainable financial independence, create value for employees, value for shareholders, improve your chances of succeeding with customers. But I really think it has to be for the right reasons at the right time. And I think if done the right way, it can be great. But be careful and make sure you're kind of aligning the interests of what you're doing with the long-term interests of the company and the customers and the employees. And if you are, you'll create sustainable value for shareholders along the way.
Yeah. All right, maybe we'll take one last question from the audience. Maybe for you, Scott. Can you talk about observations that you see U.S. and China? How do you think that's going to impact e-commerce finance. It's a question that comes from Amir from the audience. Can you talk a little bit about this?
Yeah, look, I mean, it's been a fascinating few years. We obviously, as I touched on a little bit earlier, we very much recognize that we are in an interconnected world. We see it obviously, the first time I did, post-COVID, we've been doing these town halls and employee meetings all over the world. And I did a breakfast with Asia. So it was 10 o'clock at night here in New York. And I had people on from our offices everywhere from, Australia, Korea, Japan, Philippines, China, Hong Kong, India, Pakistan, Bangladesh, I mean, all kinds of places. And we were all at home. We were all experiencing the exact same challenges at exactly the same time. And at Payoneer, we've been focused on and thinking about how interconnected the world is and how technology actually accelerates all of this interconnectedness around the world, and how I was seeing, again, how so many of us, in a challenging way, but also in a beautiful way, just how interconnected we all are, experiencing the exact same thing at the exact same time, which I really don't think has ever happened before, probably in the history of the world. So I think what we see is, there's all kinds of stresses and tensions around the world. We see it in different places. I certainly don't have a crystal ball that tells me how all of these things are going to play out. But I can tell you, we're in a period of time where it's never been more clear how interconnected and interdependent we all are on each other. And it's also clear that there are different parties around the world trying to shape their role in this kind of future digital world that we're rapidly moving into. And I think it's very hard to tell how it's all going to play out. We feel quite fortunate to have legs and arms in all of these places, and a chance to try to support businesses around the world as they're trying to succeed, as the world is changing and evolving very quickly around us.
Yeah. All right. Time flies when we're having fun. Scott, Eyal, and Assaf, thank you very much for both your time and your insights. And let me turn over to Michal just to wrap us up. Thank you.
Thank you.
Well, thank you very much, Omri. Thank you to all our panelists for joining us today. It's been a pleasure hearing you and hearing a little bit about your experience. Once again, have a great day because you've just woken up. For those of you that want to hear more about our FinTech report, we will share the link with you in our follow-up email. And also, if there's any companies out there, we do have a final day to apply to the Making Insurance Better Challenge, which is the IDI Startup Challenge. So here's the link as well. Both Viola and Startup Nation Central, together with Moneta as well, a mutual attempt to get more opportunities to use startups out there. So once again, thank you for joining us today in the Israeli FinTech, an outstanding year with definitely challenges ahead, as our speakers just mentioned. Please make sure that you follow us and Viola on our social media channels to hear more about our events and anything else that is happening in the ecosystem. Once again, thank you for joining us, and we wish you a very, very good morning or evening.
Thank you so much.
Thank you.
Thank
Bye-bye.
you.